What I'm about to tell you is not speculation. It is not a prediction built on hope or hype or the kind of wishful thinking that pollutes most precious metals content on the internet. What I am about to tell you is a sequence of documented, verifiable, and accelerating events that are converging on the silver market right now with a force that the mainstream financial world has not yet begun to comprehend. And when they do comprehend it, when this story finally breaks through from the specialist community into the mainstream financial press, the silver price will already be somewhere that makes today's levels look like the bargain of a generation. The unthinkable is about to happen to silver, and I mean that in the most literal sense. The scenario I'm going to walk you through today is one that most analysts have categorized as a tail risk, something possible in theory but too extreme to seriously plan around. I'm here to tell you that this scenario has crossed the line from tail risk to base case. The evidence is no longer ambiguous, the pattern is no longer deniable, and the implications for silver holders and silver investors are so profound that I would be doing you a disservice if I softened this or buried the lead. China is moving toward a silver export ban. And if that happens, when that happens, the global silver market as it currently functions will cease to exist in its current form. Let me give you the full picture so you understand not just what is happening, but why it is happening and why it is almost certainly going to get more extreme before it gets resolved. China is the world's largest silver producing nation. China is the world's largest silver consuming nation. And China is currently running a domestic silver deficit, meaning they are consuming more silver internally than they are producing. We already covered in a previous conversation the fact that China flipped from net silver exporter to net silver importer. But what has happened since that flip is what elevates this story from significant to historic. The deficit has not stabilized. It has accelerated. Chinese domestic silver demand is growing faster than anyone projected even 12 months ago, driven by three forces that are not slowing down and are not reversing. The first force is China's solar manufacturing dominance. China manufactures approximately 80% of the world's solar panels. Every solar panel uses silver. As global solar installation targets have accelerated, driven by climate commitments, energy security concerns, post the European energy crisis, and the economics of solar, which have now made it the cheapest form of new electricity generation in most of the world. Chinese solar factories have been running at maximum capacity and demanding silver at rates that are straining the entire global supply chain. China is not just consuming silver for its own domestic solar build-out. It is consuming silver to manufacture solar panels for the entire world, and the world cannot get enough of them. The second force is China's electric vehicle industry. China is the largest EV market on Earth, and its domestic EV manufacturers, companies that most Western investors cannot name but that are producing vehicles at scale that rivals the entire Western auto industry combined, are consuming silver in quantities that were not in any analyst's demand model 3 years ago. Every EV contains significantly more silver than a conventional internal combustion vehicle. Multiply that silver per vehicle number across millions of vehicles being manufactured monthly in Chinese factories, and you start to understand the scale of the demand pressure being placed on Chinese silver supplies. The third force is China's military and technology modernization program. The Chinese military is in the middle of the most aggressive modernization effort in its history. Advanced weapon systems, electronic warfare capabilities, next-generation communications infrastructure, hypersonic missile technology, naval expansion. Every one of these programs requires silver, not symbolic amounts, substantial industrial amounts. And the Chinese government has made it explicitly clear through its published strategic planning documents that these programs are national priorities that will be funded and executed regardless of cost. When a government with China's resources and China's planning horizon decides that military modernization is a national priority, the commodity inputs for that modernization get secured. They get secured quietly, strategically, and at scale. And silver is one of those inputs. Now here is where this story moves from concerning to critical. China has already begun restricting exports of other critical materials that it dominates: gallium, germanium, graphite, rare earth elements. In each case, the pattern was the same. China first allowed global markets to become deeply dependent on Chinese supply. Then, when geopolitical tensions or domestic demand pressures reached a threshold, China restricted or banned exports with relatively little warning. The Western world scrambled, prices spiked, supply chains were disrupted. And in every case, the countries and companies that had not prepared for the restriction were left in an extraordinarily vulnerable position, while those who had anticipated it and stockpiled were protected. Silver is next. The internal logic of Chinese strategic resource management makes a silver export restriction or ban almost inevitable. China needs silver for its own industrial programs more urgently than it needs the export revenue from selling silver to the rest of the world. China has demonstrated clearly and repeatedly that it is willing to weaponize its dominance of critical material supply chains in response to Western sanctions, trade restrictions, and geopolitical pressure. And the trade war dynamics between China and the United States, which have escalated dramatically and show no signs of de-escalation, create exactly the kind of geopolitical environment in which China would view a silver export restriction as both strategically rational and politically satisfying. The question is not whether China will restrict silver exports. The question is when. And based on everything the data is showing right now, the answer to that question is sooner than the market currently believes. Now, I want to explain what a Chinese silver export ban actually means for the global silver market in practical terms, because I think most people underestimate the magnitude of the disruption it would cause. Global silver mine production is approximately 820 to 850 million ounces per year. China accounts for roughly 100 million of those ounces from domestic mining. But China's role in the global silver supply chain extends far beyond its domestic mining output. China is a major processor of silver ore from mines around the world. Silver ore mined in Latin America, Africa, and other parts of Asia is shipped to China for refining and processing. When that refined silver comes back out of China into global markets, it is counted as part of global supply. A Chinese export ban would not just remove Chinese mined silver from global markets. It would remove Chinese processed and refined silver from global markets. The actual supply impact of a full Chinese silver export restriction could be 150 to 200 million ounces annually, somewhere between 18% and 25% of total global annual silver supply, gone from the market essentially overnight. Take 18 to 25% of global annual supply off the market while demand is at record highs and accelerating. Run that scenario through any commodity pricing model that has ever been built. The output is always the same. The price goes to wherever it needs to go to ration the remaining available supply among competing uses. And given that many of the silver's industrial uses, solar panels, EV components, military systems, medical devices, have very low price sensitivity, meaning buyers will pay dramatically higher prices before they reduce their consumption. The price level required to balance supply and demand in that scenario is far higher than most people currently believe is possible. This is where the supply deficit story becomes inseparable from the China story, because you cannot understand either one without understanding the other. The global silver market has been running a supply deficit for multiple consecutive years. The Silver Institute, which is about as conservative an establishment a source as exists in the precious metals research world, has documented annual supply deficits that have been drawing down above-ground silver inventories. Above-ground silver inventory, unlike gold, is not vast. Silver has historically been consumed rather than stored. The gold that has ever been mined in human history is estimated to still exist in some form. The silver that has ever been mined in human history has largely been consumed, used in industrial applications where recovery is uneconomic, dispersed into products, and permanently removed from the above-ground supply pool. The above-ground silver that remains available to the market is a fraction of what most people assume, and it has been declining every year as deficits are funded by drawing it down. When you layer a Chinese export restriction on top of a market that is already in structural deficit and already drawing down limited inventories, you are not looking at a supply squeeze. You're looking at a supply shock. The difference between a squeeze and a shock is the difference between a painful dislocation and a historic repricing event. A squeeze is what happens in 2020 when COVID disrupted supply chains temporarily and silver tripled before normalizing. A shock is what happens when a structural supply removal is permanent or semi-permanent and the market has to find a new equilibrium price that can balance a supply and demand over a multi-year horizon. The 1970s oil embargo gives you a sense of what a commodity supply shock looks like. Oil did not spike and come back. It repriced to a new level that reflected the new supply reality, and it stayed there. Silver, in a Chinese export restriction scenario, would not spike and come back. It would reprice, permanently, to a level that reflects the new supply reality. I also want to address the comics dimension of this story because it is critically important and almost never discussed in the mainstream coverage. The comics futures market is where the silver price is officially discovered. The paper silver market, the futures contracts, the options, the swaps, is many times larger than the physical silver market. For years, critics of the silver market have argued that this paper market suppresses the silver price by allowing entities to sell silver they do not have, creating artificial supply that keeps prices lower than the physical reality would imply. I'm not going to get into the debate about whether that suppression is intentional or systematic. What I will say is this: the paper silver market only functions as a price discovery mechanism as long as participants believe that physical delivery is possible if they demand it. The moment that belief is seriously questioned, the moment that enough participants in the futures market decide they want physical silver rather than cash settlement, and the physical silver is not there to deliver, The relationship between the paper price and the physical price breaks down. A Chinese export ban would be the most powerful test of that relationship in the history of the modern silver market. If 18 to 25% of global supply is removed suddenly and COMEX warehouse inventories, which have already been declining, cannot meet delivery demands from futures contract holders, you would see a fracture between the paper price and the physical price, unlike anything the modern financial system has experienced. Physical silver would command a premium over the paper price that could be enormous, and the paper price itself would be forced dramatically higher, as the arbitrage mechanism that normally keeps them aligned breaks down under the pressure of genuine physical scarcity. This is the unthinkable scenario. Not unthinkable because it is impossible. Unthinkable because the mainstream financial world has not seriously modeled it, has not prepared for it, and will be caught completely flat-footed if and when it begins to unfold. Now let me tell you what serious investors should be doing right now given everything I have just laid out. The priority, above everything else, is physical silver in your direct possession or in fully allocated audited storage outside the banking system. Not an ETF, not a futures contract, not a paper promise. Physical silver that you own outright, that cannot be lent out, that cannot be hypothecated, and that is not exposed to counterparty risk. In a supply shock scenario, the divergence between paper silver and physical silver could be dramatic. The only way to be certain you benefit from that divergence is to own physical silver that is not dependent on anyone else's ability or willingness to deliver. The second priority is silver mining companies in politically stable jurisdictions with low all-in sustaining costs and strong balance sheets. In a genuine supply shock scenario, miners who can produce silver at $15 to $18 per ounce all in and sell it into a market where silver is trading at $100, $200 or higher will generate profit margins and cash flows that will be difficult for the market to initially comprehend. The stock prices of these companies will reflect that reality with a lag, meaning there will be a period where you can buy miner stocks that are not yet fully pricing in the supply shock scenario. That window will be short. The third consideration is geographic diversification of your physical silver holdings. If a Chinese export ban triggers a broader geopolitical escalation, the confiscation risk and access risk for precious metals stored in certain jurisdictions becomes a real consideration. Diversifying your physical silver across multiple stable jurisdictions is not paranoia. It is prudent risk management given the geopolitical trajectory we are on. The fourth consideration, and I want to be very deliberate about this because I do not want anyone to over-leverage themselves based on a scenario that has a range of possible timing outcomes, is position sizing. The China export ban scenario is the highest conviction macro thesis I have seen in over a decade of following this market. But highest conviction does not mean certainty. It does not mean tomorrow. It means that the probability-weighted expected value of being positioned in physical silver right now is extraordinarily high relative to the price you are paying. Size your position based on your financial situation, your risk tolerance, and your time horizon. The worst outcome is being right about the thesis, but being forced to sell your position before it plays out because you overallocated and created liquidity pressure for yourself. I want to leave you with one final thought that I think captures the essence of what is unfolding right now. Throughout financial history, the greatest wealth transfers have always happened at the intersection of a structural supply constraint and a demand shock that the market had not priced in. The people who saw those intersections forming, who understood the supply side and the demand side and the geopolitical triggers that would accelerate the repricing, and who positioned themselves before the mainstream recognized what was happening, those are the people whose financial stories became legendary. The people who waited for confirmation, who waited for the mainstream to validate what the data was already showing, who waited until the supply shock was already making front-page news. Those people participated, but they participated late, and they left the majority of the returns on the table. The silver supply deficit is documented and accelerating. The Chinese demand pressure is documented and accelerating. The Chinese strategic resource restriction playbook is documented and has already been executed against gallium, germanium, graphite, and rare earths. The COMEX inventory decline is documented and continuing. The basis compression toward backwardation is documented and signaling physical tightness right now. Every piece of the puzzle is on the table. The picture is visible to anyone willing to look at it honestly. The unthinkable is not coming. It is already beginning. The only question is whether you're going to be positioned before the rest of the world figures that out. I will see you in the next one.